I think we're live. What's up, everybody? Are we here? Can somebody please let me know that we're good? Because I have no idea if we are or not. I did all the sound checks and video checks that I could do, but I really don't know truly how well we're doing until I hear from you. So please let me know in the comments. Can you hear me loud and clear? Are we good before we get started? Darren sees me. I need you to. Yeah, a little bit of a different setting. Sounds great. Okay, cool. Perfect. What's up, everybody? Welcome to Own the Chaos. My name is Brad. The stock market's crazy and chaotic. I made it my mission to help you own it. And we are not in the studio, as you can see. I'm actually in Charlotte, North Carolina, visiting some friends that you guys might know of. Peter has a place down here that I'm Peter Saddington. He was on the show a little bit ago, and he's got a place down here, inviting me to check out what he's got going on. So I'm down here checking that out. So obviously you don't have a studio down here. But I wanted to go live with you guys regardless. It's still Thursday. It's still 3:45 p.m. Eastern Standard Time. And so I wanted to make sure that I still we can obviously no, it's actually like a conference room or something that I'm in. But yeah, so that's what's going on. That's why I'm down here. But as always, let me hit everybody up with the starting five. We got Jonathan Schreiber, Jeff Polnicka, Philip Stroh, Alma Gaudy, and Eric Brand. You guys are our starting five. If you did not make the starting five, it's probably because you didn't hit that notification bell and you didn't get notified that I was going live. So make sure you're subscribing and hitting that notification bell, guys, because you might make the next starting five. Who knows? So a couple things. No Freddie today. I know it's Thursday and a lot of you guys might be bummed, but Freddie does have a day job, believe it or not. And his day job is preventing him from coming onto the live stream today. So no Freddie this week. You just got your boy B. All right. So listen, I know what the title says and I know what the thumbnail is, but it got you to click, right? That was the whole kind of point. And we're still going to be talking about oil and what Joe Biden is doing. But I want to preface this by saying this isn't a Joe Biden bash fest. Okay. This isn't, me trying to do any of that. But the fact of the matter is that Joe Biden is looking to dump a lot of the reserve oil into the market. And we're going to talk about why I think that's a bad idea. You know, it wouldn't matter if it was a Republican president or a Democrat president or an independent president. If we get one of those one day, which I hope we do, it wouldn't matter. This decision, in my opinion, is bad for gas prices. It's bad for your wallet. I'm going to explain reasons as to why I think gas prices are going to continue to go higher, even though we're releasing a lot of this from some pretty reliable statistics that we've seen in history. And also going to give you some stocks, some oil stocks and energy related stocks that I think are going to continue to go up as a result. So, you know, again, I see a lot of people already kind of talking in the chat. What I would like to refrain from is just the overall, bashing, political bashing. I think that we all can be adults and have a grown-up conversation about this, is that even if it's your guy or even if it's not, we can all agree that maybe some decisions just aren't the best ones. So that's how I'd like to preface this. Okay. I don't know if this is actually how this, if we're going to continue to go down this rabbit hole. However, I would love for it if we didn't see all kinds of Joe Biden bashing, because that's not what today's show is about. It's just about oil prices in general and what this decision means for your wallet, and how you can benefit from potential stocks moving and which ones are lagging quite a bit, and actually still present opportunities despite the monster moves that we've seen in oil and energy stocks in general. Right now, the stock market's pretty quiet. I mean, we have the S&P down around 1%. Excuse me, not really a big deal. It's down around 43 points. The Dow's around 374. NASDAQ is down around 117 points. So we're having a red day, but over the last 2 weeks, we've had monster green shoots all over the place. They're seeing the price of WTI crude is down around $101. a barrel. So that's down 6.5%. It's down quite a bit from its $130 highs that we saw earlier in the month. But again, like I said, I think this is going to be temporary. I think this is going to be something that probably actually exacerbates the problem, because we're not seeing any solutions to the supply issue, right? This SPR is not really what's going to really solve anything long term. And I would challenge anybody to actually defend that. I don't think that we're going to see. Some people are making the argument that the SPR allows us to buys us time. It buys us time to really kind of dive into oh shoot, where am I going to? I just lost my train of thought. Damn it. Somebody help me out. Hold on one second. Because I wanted to get into what exactly the SPR is, so that you guys can really kind of, let me see here. I had some really good information pulled up, so that's where I was going. I promise I'm going somewhere with this. So the SPR, if you guys don't know, is the oil reserve. So anytime that we dip into the SPR, it's because we have oil that's just reserved. It's sitting there ready to go. And the issue here now is that we're seeing Joe Biden and the White House release 1 million barrels of oil from the SPR per day for the next 6 months. So for the next 180 days, we're going to see 1 million barrels of oil being released from the SPR. And historically, it usually ends up leading to higher gas prices and higher oil prices as well. We look back all the way let's just date back to 1997. We saw SPR release back then. Oil prices went from $25 all the way up to $50 per barrel. Happened again back in 2001. All it did was go up. I'm looking here again around 2006. Oil prices went up, and we all know what happened between 2006 and 2008, right? I mean, we saw $4 a gallon of gas then. And even just recently, the Biden administration also released about 30 million barrels of oil from the SPR, and it didn't do anything other than continue to raise oil prices. And why is that? That's kind of the big question here. Why did oil go up? Because of the release of the SPR. Now, obviously, you can see today oil is down, but I'm willing to bet over the next couple of days, maybe even weeks, it's not even going to take that long before oil starts to shoot back up. And I think the reasons this is my theory, but we look at this and see this as a cry for desperation, right? We have no other choice than to dip into the SPR unless we want to produce more oil. And it seems as if the Biden administration isn't willing to do that. I think that this is a mistake. I think that the solution is to try to get things producing again. We need to, I don't want to say drill. We have plenty of oils that have been drilled, but getting and producing oil on this side of the states or this side of the ocean is really the only solution. I mean, the Saudis aren't willing to play ball. OPEC meeting was just today, and they weren't changing anything, right? The OPEC meeting came in, they were like, it's business as usual. We're not going to continue to we're not increasing output anymore. We know what demand looks like, but the supply is they're making money hand over fist. So OPEC came in this morning, they didn't change a damn thing. Biden comes in and says, hey, we're going to increase oil by a million barrels. We're going to release oil by 1 million barrels per day for the next 6 months, and we'll see where we're at. But again, 75% of the time that this happened over the entire history of having the SPR, 75% of the time, oil continued to go up. It's not going to solve the problem. We're only putting a Band-Aid on it, and we've kind of continued to kick this can down the road. The other side of this, too, is that the Biden administration are putting plans in place for what's the term? That just escaped me. Okay, well, it'll come back. It'll come back. Putting plan in place for minerals needed to continue to increase production on EVs. The problem with this is that it's not going to happen fast enough regardless. So production is still going to be a problem. And 6 months down the road, demand for oil is still going to be ridiculously high, and we're still not going to have the supply there. Because remember what I had told you about earlier about how, with the Russia-Ukraine crisis, even if the war ended today, if it ended before this live stream was over, the issues are going to remain that sanctions aren't going to be lifted. That's one. And you can't just start producing oil and get it out immediately either. So that's going to continue to pose a real big problem, regardless of what goes on in Europe. So this issue with oil and energy is going to remain no matter how much you try to put this Band-Aid on it. I mean, we saw what happened when the 30 million barrels of oil were released for one day. That's only about a day and a half's worth of the entire supply for the U.S. So the U.S. goes through about 20 to 25 million barrels of oil per day. They release 20 to 30. You're only getting a day and a half worth of oil there. And in this case, you're not really changing much either. I think, and I've said this before, that we see record numbers as far as travel is concerned. I think people are dying to go out on vacation right now. Nobody's canceling that. It doesn't matter how high oil goes. So I think that, in my opinion, this is going to be a problem that continues to grow, and the solutions here are just not there, unless at some point in between those 6 months, somebody decides to break and say, you know what, we're going to have to produce more oil here in the States. That's just the solution. And in my opinion, that's the only solution. That's the only way we're bringing oil prices down, is if we actually make it here in the States. And I haven't really seen any other argument for, as far as alternatives are concerned, that where there's going to be a better solution. Peter Saddington's in the house. What's up, Peter? Yeah. What's up, man? Good to see you. Everyone wants to travel. Yeah, absolutely. So, to that end, that's why we were in a bunch of the travel companies, right? Airbnb was something that I've been pretty bullish on. Well, from last year well into this year. Obviously, it's had some troubles because of the overall volatility in the market, but Airbnb has been something that I've been really bullish on. Great company. They're back to making money. The growth there is significant. We're even seeing old people use Airbnb. If you guys didn't catch the metrics on that, search volume from people that were 60 years old or older went up 60%. 65% over the last 2 quarters. That's an incredible number for people from that age group going and using Airbnb. Typically, you would think that that's a smaller or a younger age demographic, if you will. So the older people are figuring it out. Airbnb, I think, is still going to be something that gets used up a lot. We're seeing production on RVs also ramp up despite the cost of gas going up. So I think there's going to be a lot of opportunity here in the travel stocks, but also in energy. Energy is still not done. So a couple of things I wanted to show you here. Let me go ahead and share my screen with you. We're going to look at a couple of things. So ETF OIH. There we go. Let's look at the OIH real quick. This is the oil services. And OIH has had a monster run, relatively speaking, right? Here's the daily chart. And we've been following the OIH since last summer, since last June. This is the oil services. Some of the major components here are Schlumberger. We also have Halliburton, Marathon Oil, a lot of other ones also that are made up into this. But Schlumberger and Halliburton are the 2 biggies, right? And we can look at Halliburton and see how that's obviously moved. But this is the ETF that kind of gives you the idea of what's going on here. So this is the daily chart. Oil's still at $100 a barrel as of right now. It's trading at 282 is where the OIH is. Let's take a look at see last time that oil was around this price, around $100 a barrel, where OIH was sitting. Let's go back out to the weekly chart. Okay. 2014 was right around that time. We saw $100 a barrel oil. Even 2016. But you can kind of see the picture here, right? See how much that OIH and the oil services ETF has lagged the price of oil. So 2015, 2016 was right around where oil was sitting at now. It was actually lower. And you're looking at the OIH that's still sitting at $700 at that time. We're still just warming up, in my opinion, here. I know that it feels like oil and oil stocks have had really great moves, and they've continued to outperform the market from last year well into this year as well. But you look at this and you think to yourself, this is really telling, right? I mean, obviously there's different factors here as well. And I'm not saying that OIH is for sure going to double from here, but you can bet that there's a lot of momentum behind this still. And there's this lack of participation from the overall market as well. There isn't the type of volume that we're seeing that we saw previously. And so I think that if you look at the S&P 500, energy stocks still only really make up around 3-4% of the overall S&P. So there's still a lot of room, a lot of rotation that could happen that goes into energy. We look at the XLE, for example, same type of deal. The XLE has definitely had better moves here, and that's in full-blown breakout mode. The XLE is 74.57, which is the price that we saw back in 2014, and the XLE is finally actually catching up to the price of oil. It still has a lot of room to go, I think, but you look at that and compare it to the OIH. Obviously, the OIH, I think, is much more attractive than the XLE is, but you can see that looking on the weekly chart that this is in full-blown breakout mode. So these are two ETFs that you could certainly take advantage of. What's in the XLE? The major holdings here are going to be ConocoPhillips, ExxonMobil, Chevron. These are all great. And even if, let's bring it back here for a second. Even if, let's just say oil doesn't move, right? Let's just say that what Biden's got going on is actually going to keep oil where it's at. The profit that they are making right now is ridiculous. We look at Marathon Oil, for example, and we've talked about that. Marathon Oil is profitable as soon as oil hits $35 a barrel. That's when they start making profit, at $35 a barrel. So you think about where it's trading at right now and the kind of profits that Exxon, Chevron, Marathon Oil are making, and it's ridiculous, absolutely insane. So even if it levels off, the dividend yields on those are around 9-10%. So they're really good dividends if it just stays where it's at. But again, I don't think that it is. So I think there's a lot of upside here to go. Let's take a look at let's see here. Oh yeah, you could drop a link, Peter. That's cool. No big deal, man. Check in some of the comments. So that's my spiel on oil. I think that that's going to continue to move and do really well. And actually, I haven't looked at Marathon in a while. When I say a while, I mean like a week or two. We take a look at Marathon Oil. Yeah, still full-blown breakout mode. And we can actually be looking at this as a potential cup and handle pattern on a weekly chart. Let me show you what I'm looking at here. So this could be actually bullish for something like a Marathon Oil. So this is ticker symbol MRO. And I really like this chart here. This is a pretty decent setup. Nice little cup and handle if we're looking at the weekly chart. So the breakout here could be extraordinary. And there really doesn't seem to be a whole lot stopping it. We're looking at the chart here to around $30. And if we go back to that time that I was telling you about in 2014, where we saw oil at these prices, 2014, 2015, that's right around where it was sitting at those prices. So Marathon Oil, relative to the price of oil, still also could potentially have a lot of room to run here. Last one I'll say is Transocean. So I actually own this one, and I have calls on this one. I'm in options on Transocean. We look at Transocean back when oil was sitting around $100 a barrel, and Transocean was sitting at $22.10, thereabouts. That is wild. Stock sitting at $4.58 in the after hours right now. So you can kind of imagine where this may or may not be headed. Obviously, there's a lot that could happen. But I think that this has lagged significantly. And if by some chance the Biden administration decides, hey, you know what, we're going to have to continue to start drilling for oil, we have no choice, which I think is the direction where we're headed. Transocean is going to benefit significantly from that. This company drills out offshore into the Gulf. And, I think this is one that's certainly being overlooked. The calls are nice and cheap if you want to get in on some options, but obviously the stock is very cheap too. And if you just want to take up straight up shares, especially with the assumption that maybe this could at least double from here, considering where the price of oil is at, I think that that's certainly worth taking a look at, right? Like, I'm not going to tell you just go out and buy it, but I'm making the argument here that I think is pretty compelling. But let me know what you guys think as far as that's concerned. Would love to hear from you on that. Sweet. Lots of people subscribing to Peter's channel. Yeah, go check him out, Peter Staddington. I love that people are giving him some love. Appreciate that. Yes, they did. So Mike Hudson says transition fell apart because of the Deepwater Horizon explosion. Yes, they did. Back in 2010, I believe it was 2010, they fell off. So that was really obviously tragic. I wonder though if you have to imagine that enough time has passed now to where that's not. I mean, and again, that was 2010, and we saw where transition was sitting in 2014. So that's another side of the argument too. So yes, they got wrecked when that happened, but it's still trading at pretty high price. And if I look at this, let me look at the PE on this too. It's probably, I haven't looked at where this is fundamentally. Forward PE is negative, so you can imagine like this is pretty cheap. Looking at Marathon Oil, 4P is at 7 times. It's trading at $25. It's had a monster move. It's up 100% from this time last year. The forward PE is at 8 times next year's earnings, 7.8 times next year's earnings, which is wild. Price of sales is at 3.6, so that's a little bit on the high side, but nothing crazy. But that forward PE is wild, absolutely insane. And this affects other things too, right? This doesn't just affect oil. This affects other commodities, and we've talked about how Cleveland Cliffs is still dirt cheap, despite the monster move that it's had. It's finally corrected down a little bit more. I think the steel companies, Alcoa's, aluminum, commodities are going to be ones to own still moving forward. And I know that they've moved a lot, but there isn't any signs of this slowing down anytime soon, especially when we have supply chain constraints and we're not going to be buying or taking anything from Russia. I think that that's going to continue to be a thing. I mean, we have this infrastructure bill that's out that, we have so much money that still needs to be spent on infrastructure. And I think that we look at some of the commodities there as well. And I don't see how we see any kind of slowdown in that area either. Yes, hit that like button. We got 81 of you guys hanging in here. I figured it was going to be a bit of a light stream, but I appreciate you guys allowing me to be part of your afternoon. So if you wouldn't mind hitting that like button, I certainly would appreciate it. And now's probably a good time to let you guys know about the Chaos Crew as well. If you guys are not part of the Chaos Crew, you might want to join. Hit that join button next to subscribe. Would love to have you guys as a part of the crew every single morning before the market goes live. I put out a watch list of 5 stocks. I break it all down for you and give you the fundamentals and the technical breakdown as well on what I think might be moving in the market that day. If you're having trouble trying to figure out where to look no further. You can hit the join button next to subscribe and become part of the crew. We'd love to have you guys there. If you can't see it, I know a lot of you guys that might be out of the country or what have you. There's always restrictions involved with that. You can go to ownthechaos.com. You can also sign up for it there as well. We do our level 2 live streams as well, which I'll be doing that later this evening. We do portfolio reviews. I show you my portfolio, how I'm comparing to the market. Last year we did really great. This year I'm still underperforming the market a little bit, but we're working our way back up. March has obviously been really kind to me, and I'm actually really starting to catch up to the overall market. So I'm super pumped for the second half of this year, which is where I think I'm really going to start to ramp things up. But if you guys want to check to see what I'm in, and you want to check that out, make sure you're hitting that join button next to subscribe. We'd love to have you guys in the Chaos Crew. Good question. Peter Saxon says, what do you think? What do you think about the long-term war will affect the markets? It's an interesting question. It's hard to determine when, let's just say the war ends. Let's just say it ends tomorrow. It's hard to determine when anybody would feel comfortable buying anything from Russia for a very long time. I think it would have to take Putin not being there anymore. Just my take on that. I think that that's what would be the acceptable route for anybody in the EU or even in the US to do any kind of business with Russia, right? Because, I mean, you just think about all the horrible things that he's done over the last 2 month now. I can't believe it's only been a month. So five weeks that this has been taking place. I have to imagine that the only way that we start to do business again with Russia is if Putin's no longer there. And I don't know if I guess the dude has to die in order for that to happen. But that's kind of where I'm at as far as that's concerned. But as far as global commodities, I think that there's got to be opportunities. There has to be. You look at the wheat supply, 75% of fertilizer comes from Russia and the Ukraine in that area. So where's it got to come from? So there is definitely going to be a shift at some point. If nobody's willing to do business with them and they're not going to do it from there, it's got to be somewhere else. And I would say that there's got to be opportunities as far as that's concerned. Maybe here in the US, maybe we start to grow our own wheat somewhere. That's a really great question. I do think that inflation is going to continue to get ramped up here. I don't think that we're going to see as high of inflation that we saw over the last several months. I think there's potential that we could have peaked. Maybe even now or next month, we could see the peaking of inflation. And a lot of it, again, has to do with the supply chain issues. I think if we see the supply chain ease a little bit, which we're starting to see some of that could abate a little bit as far as inflation is concerned. But I think this inflation conversation continues to move down the road, maybe over the next couple of years. Maybe we see around 6 to 4% inflation next year. That's still going to be a lot, but it won't be as bad as it is this year. But I think a lot of it's going to have to do with the war in Ukraine as well. So really great conversation. I think there's a lot of rabbit holes we could dive down into as far as that. But I love that. I'd love to continue to have that conversation. Javier says Russia's attitude to the West won't change under different leadership. You might be right, and I'm not saying that that's going to make things all better. Like if Putin is no longer there, that it's just going to make the world better. Everybody's going to be happy doing business with him. But I think that if you look at the war crimes that this dude has committed, at least when there's somebody else in there, you can kind of make the argument, well, we can at least do business with this person because they haven't committed genocide on anybody yet. I mean, look, I'm not a politician and I don't claim to be an expert in geopolitics either, but I got to imagine that the last thing that anybody's going to want to do is business with Putin. And the only way that they're going to do business with Russia is if he's no longer there. That's my opinion on that. Mayo says the problem with your strategy is Fed Reserve interference. Yes, the Federal Reserve is going to continue to raise rates, and we've never really seen a situation in which the Federal Reserve has raised rates and created any kind of soft landing. I don't know if there's really been an instance in which more of. We talked about it yesterday about a potential recession that could be coming in the next 18 months, 2 years. I think it's a possibility. I'm not saying that it's going to happen, but the headwinds are there, right? We have inflation, the Fed's raising rates, there's war going on, there's supply chain issues, and then there's the demand side of it. I think that at some point, prices are going to get so high that demand gets destroyed. And where does that happen? I really can't tell you. Nobody's going to be able to predict that kind of timeline for you. And so if I had to guess, if the Fed continues to raise rates, in which a lot of people think that they're going to, I think that there's potential for this to happen maybe in 23. I think that's going to take 2%, maybe even 3% interest rates before that actually happens. But at some point, and then we've seen this before, the Fed continues to raise rates until something breaks. And that's been the MO. Maybe Jay Powell's got another trick up his sleeve as far as that's concerned, but I really doubt it. And I don't know if there isn't a whole lot of other tools at his disposal that's going to really kind of prevent that from happening. It's either you take care of inflation or you don't. And the only way he's going to be able to do it right now is to raise rates. And obviously, there's still some more things that are not in his control. The supply chain issues are still going to be a problem, and the Fed can't do anything about that. But you're right. The Fed is also something that you have to be concerned about. Is that true? Putin just signed an order to draft another 150,000 troops. That's going to last for a while. If that's true, that sucks. Sucks for a lot of people. But yeah, guys. All right. So because there's no earnings today, I wanted to throw a shout out or have you guys shout out some stocks that you would like me to take a look at. And yeah, Jeff says it's true. That's terrible. Putin's doubling down. That is crazy, though. All right, let's check out some of the other ones. But I'm looking through some of the other questions. If you guys have any other questions, of course, throw them in there. I also want to have like a little bit of a ticker shout out. So let me know what you guys think. Peter said, "What about gold? What about Russia backing money by gold?" That's interesting. I'm not sure. I would think, I mean, and we've had this conversation, and I think that they're exploring this more so than gold. It would be cryptocurrencies. And we've seen that from Ukraine as well, looking for alternative forms of currency because nobody's willing to deal with Russia and the ruble. And we saw that just today. I mean, Russia's not willing to sell oil for anything other than rubles. Nobody wants to play ball. So maybe the route could be cryptocurrencies. And I think that's probably the more likely answer. If they do it they're probably going to do it by gold, but I don't think it's going to help them out at all. I don't think it's going to really add much to the ruble at all. Another great question. What do you think about EU, Asia, America will do now that Russia's backing money by gold? Peter's asking the tough questions. I don't know. Man. I'm going to have to get back to you on that one. Hit the like button. Yes. Hit the like button, says Bruce. I appreciate it. I see. Every time a country wants to back its money by gold, America invades. So will America invade Russia? Ooh, no, I don't think so. Not a chance that happens. I feel like if that happens, then China's got to get involved, and maybe they don't. And China's actually being a little bit smart here because they're even starting to back away from Russia at this point. We've seen that in a couple of instances, but man, if the U.S. were to invade Russia, it would have to be something to where, I don't know, some sort of narrative would have had to get spun. I don't think the U.S. just straight up invades Russia. But listen, I mean, I could be wrong. I could be wrong. I could be totally wrong. All right, getting to some of the tickers here. Dutch Brothers. Dutch Brothers has been moving a lot. Let's take a look at that because this was one that I put on our Chaos Crew watch list a couple of weeks ago. They had some really interesting earnings. Now, they're still reporting for a loss. And in this environment, as we always know, companies that report for a loss are also sensitive to rate hikes, right? If you're reporting for losses, the ability for you to borrow and grow becomes much slower than in an environment where interest rates are lower. And so, I mean, obviously interest rates aren't going crazy right now, but in this environment where we're going to continue to see rates go up, it makes it more difficult for companies like Dutch Brothers to borrow money. And so their growth could be slowed. However, the company is fantastic. And from some of our friends out on the West Coast that have talked about Dutch Brothers, I think that the growth here is actually really, really good. The customer service is up there with Chick-fil-A, and I ain't lying. I know there's a lot of people in our community that can attest to that, but I really actually like Dutch Brothers here. You can see, and we just got done talking about a cup and handle pattern. This is actually pretty bullish. We're looking at it from a technical standpoint. If I was looking at this chart and I had no idea what the company was, I was just looking at the candles. This looks bullish to me. The reason why I say that is because we're seeing a familiar cup and handle pattern. We had a little bit of it tried to break out and got rejected down here. Stock came down around 10%, but I like this setup. Again, the risk here is that they're still reporting losses, so that is a big risk, but it looks pretty darn good. I would say that I would remain bullish on Dutch Brothers, and maybe it holds up above here. I think it should. If it doesn't hold above 55, then the 50-day moving average could still be in play here at 52. It was starting to heat up a little bit on relative strength, came back down to the mid 50s. So I still like it there as well. I think there's plenty of room for this to run, in my opinion. So I actually really like Dutch Brothers. I like the fundamentals on here, and even like I said, even though they're reporting a loss, there's always room in your portfolio for speculation. If you have that room, then I would say that yes, I like Dutch Brothers a lot. Another big fund went in the BTC. They just keep coming. Goldman Sachs, asks Jeff Ponica. Goldman Sachs has been hurting, tough compared to rest of financials. What influences holding them down, and what will be a good catalyst? One of the big things that's been holding Goldman Sachs and some of the other ones down was the sanctions that were imposed by Russia because of their exposure to Russian assets. And so that's why we saw some of the bigger banks come down. Goldman Sachs, though, I still think is one to own. And really, the bigger banks are one to own. I actually prefer Bank of America over all of them as far as the financials are concerned, but they've all come down enough to reasonable levels. You look at the 4 PE on Goldman Sachs, that's at 8.5 times next year's earnings. Stupid cheap. Price of sales is at 1.8. And the chart ain't looking too good at this point. But I think that there's opportunity here regardless. Interest rates go up and banks automatically start making money. Take a look at that chart on Goldman Sachs. And in an environment like this, that's what you're going to see. Goldman Sachs also kind of took a bit of a hit. It was Goldman, Morgan Stanley, some of the other big banks that were connected to Apple. Did you guys see the Apple news? Apple was looking to become their own merchant, essentially, become their own bank for their customers. And Morgan Stanley and JP Morgan, I think, were their bigger providers in that space. So we saw those stocks actually come down, and some of the other banks got ripped down with it. But Goldman Sachs, I think, is still good. But again, if I had to pick one financial that I like right now, it's Bank of America. Obviously had a tough day today with the rest of the market, but great balance sheet. The growth here is substantial. They instantly start making money when interest rates go up. The next rate hike that goes up, Bank of America's revenue stream continues to go up. They don't have to lift a finger. There's no marketing expenses that they have to incur. None of that. They don't have to lift a finger. And they automatically start making money because interest rates go up. So I actually like Bank of America here over all of them. But I think the financials in general are going to continue to do well. I appreciate the questions getting answers in the chat. Edgar says opinions on Bitcoin miners, and then Peter already handled that one. Couldn't agree more. Savvy Money Show. Yeah, I saw that the pot stocks were popping off today. House Rules Committee formally cleared a federal marijuana legislation bill for floor action for a vote. Do you think MJ stocks will go or wait for floor vote as it usually gets voted? So for me, I think cannabis stocks are interesting. They all have some sort of form of dilution. We talked about this briefly last week, I believe, or maybe it was on Monday, where I brought up some of the balance sheets on like Aurora Cannabis. They have $157 million in convertible debt. The stock's trading at like $3 and they have $150 million in convertible debt. That means that is debt that's going to be converted into shares, which is good for the company and good for you. So if you're an investor of something like that, and most of the cannabis stocks are like that because they weren't able to borrow money on the federal level, so they had no choice than to just raise capital by selling stock, and it's just crushing investors. There's only one cannabis stock that I actually kind of sort of like, but it's also not really performing the way that you would hope because cannabis has been such on the struggle bus. But that's Canopy Growth. They have the backing of their parent company, which is Constellation Brands. And I think that that's the only viable one that I think actually has a decent future because the other ones are so riddled with debt right now and they have no choice but to just bleed their investors dry with dilution. And dilution is not your friend. I mean, case in point on how dilution works. The cruise lines right now. We got Royal Caribbean, Norwegian, and Carnival. Carnival Cruise Line has so much convertible debt, it actually is more than what their market cap is. Let me say that again. Carnival Cruise has more convertible debt than their actual market cap. That's the one stock that's not performing while the other two are. Now, the other two do have convertible debt, but not nearly as much as Carnival does because they did a bad deal and it ain't going to work out. So be careful on those cruise stocks. They've obviously been super volatile and they still have a long road ahead of them. But Carnival is just an absolute trash machine. So I would hold off on anything that goes through dilution, and most of the cannabis stocks have that. Okay. We'll go through a couple more. Is AMD a buy now? Ed Nolan asks, is AMD a buy now? Let's take a look at AMD. AMD, I'm pulling it up right now. It had a pretty decent pullback. I would say, I try to refrain from saying that, yes, this is a buy now, unless I just straight up go and buy it myself. But I'm looking at this and I would say that there's definitely reasons to like it. Let me show you guys what I'm seeing here. The pullback is certainly significant. This is a company that has pricing power, and in a time of inflation, I think that that's certainly worth considering. But it fell below the 250-day moving average today. So that can't be ignored, I don't think. So this is certainly an interesting spot for it because it was in the middle of a downtrend, and then it finally broke out. It got up above the 50 and the 200-day moving average after falling from 164, coming all the way down to $100. I would be hesitant to say that it's coming all the way back down to 100 because that would be another retest of the bottom here. I'd be very surprised if we saw that. So I think that there's the potential for this to bounce off of this trend and maybe move back up. I think that there's a likely scenario in which that could happen. And again, this is a stock that has pricing power. The demand for chips, the demand for semiconductors right now is insane, and the supply is just not there. So they can essentially still name their price. And these semiconductor CEOs, Lisa Su and Jensen Huang, some of the other ones aren't projecting the shortage to let up at all anytime soon. So I think that the semis are still going to be worth owning. And that goes for, all the other ones. You kind of pick your spots here, but Taiwan Semi, certainly worth looking at, especially with the correction that it's had. We always love NVIDIA. There's also opportunity, I think, here in Intel. Intel has been kind of like in the doghouse, rightfully so. But this has been an interesting development. I mean, it came up over the 200-day moving average. And that's the options chain. Came up over the 200-day moving average. And 4 PE is actually pretty low, 14 times. You look at something like NVIDIA that's trading at 48 times, and even AMD that's trading at 27 times, and Intel starts to look really attractive. So I actually like Intel here too. But yes, I would say that it's definitely worth keeping on your radar. And I would say that AMD isn't one to be given up on yet. All right. Last, I'll do one more, and that is Darren Anderson with Nail. Is down to $40.52. Let's take a look at Nail. That's an ETF. It's a Homebuilder ETF, if I'm not mistaken. Yeah, Homebuilder stock. I'd imagine the major players here are probably DR Horton, KB Homes, that sort of thing. The problem with the home builders right now is interest rates. Mortgage rates are now getting up to 5%, and that's pretty significant. So, demand's still there. There's two problems here. Interest is going up. Demand is still there, but supply is at all-time lows. There's just not enough houses to be bought. And you can make the argument that the home builders could look attractive here because of, the lack of supply. And so you have to build homes in order to, solve that problem. But I don't think that it's that simple, especially with the cost of materials. And are they going to be able to pass the costs on to consumers with interest rates going through the roof as far as taking out a mortgage? And I think that's the conundrum that a lot of investors are kind of weighing right now, and that's why nail is down so much. There's a cycle for the home builders in general, and it's called the golden 6 months. And that goes from October to about now, to around April. And we're coming out of that now. So I think we're coming out of the cycle of the home builders. I'm not saying that you shouldn't own home builders, or I'm not saying that you should abandon them, but they're really coming out of their cycle. And these are cyclical type stocks. And so I would say that if you're going to get into something like Nail or any of the home builders, it's probably going to be, it's probably going to require a lot of patience. Maybe worth taking a look again in the fall. That would be my thoughts on that. But guys, that's going to do it for me. Hope you enjoyed, my on location studio. But appreciate you. Thanks so much for tuning in. If you haven't hit the like button, please make sure you do that on your way out the door. Guys, thanks so much. I'll be back here tomorrow. Not tomorrow. It's Thursday. I'll be back here on Sunday at 7:30 p.m. Eastern time to go over Stock Watch Sunday. I'll give you guys an outlook for the week ahead. We're getting closer to earnings season, guys. I can't wait. It's my favorite time of the year. We're coming up on that in about a couple of weeks, and I'm pumped. So earnings season, I think, is going to be really exciting. You're not going to want to miss Stock Watch Sunday because I think there's a lot of really good setup leading into earnings season. So make sure you hit that subscribe button, hit that notification bell to get notified when I go live, and that's going to do it for me, guys. Thanks so much for tuning in. I'll see you Sunday.